Good morning once again, and welcome to the Haven Financial Group radio show. We thank you for listening. If anything resonates today, feel free to give us a call, 612-504-8400. Come on and visit with us or visit us online at havenfinancialgroup.com. Shoot us an email at info@havenfinancialgroup.com, whatever way you like to communicate. And again, go to our website, check out all our classes, whether you're a client of Haven or not, or you just heard of us, and come on out to our classes. They're educational. All the materials are provided. You can find it on our site. And I mentioned earlier in the show, we have Mark Milstein, a guest speaker, renowned speaker, author, health researcher. He's going to be doing a speaking engagement for us called Health and Wealth at the Ames Center, February 16th. It's on our site. Great. He'll do a book signing. Health and wealth, they go hand in hand. Without health, your wealth might not mean anything. So it's going to be a wonderful, wonderful time, and it's an honor to have him. So again, if you have any questions, that's why we're here.
Absolutely. That's something to look forward to. It sounds like a great opportunity to get some really wonderful information. 612-504-8400. That is the number where you can reach the folks here at Haven Financial Group. Glenn Ramey with us today, insurance expert who works in the Haven offices and has been a wealth of information for us today. We want to wrap up today's show by talking about some of the mistakes that maybe people make when it comes to insurance in their retirement and ways to avoid that. Glenn, I would venture to guess, because you and I have chatted enough, that you probably believe one of the biggest mistakes people make is underestimating what they're going to have to pay, like for health insurance, for example, in retirement.
100%. It's an easy thing to try to put to the side and not think about, right? Or only budgeting for premiums and not budgeting for additional expenses beyond those monthly premiums, right? Understand that, again, if we buy a cheap insurance, we're going to have a higher exposure to medical bills later. If we buy more expensive insurance, we might have a high premium, but we won't have the same exposure to those medical bills. But just understanding it isn't just the monthly costs that we're paying. Right? It's how much more in medical bills before our out-of-pocket limit is satisfied on our insurance and it takes over. Are we prepared to face a scenario where we're not dealing with a curable health condition, but a chronic one, right? I'm telling clients all the time that are approaching Medicare, I have bad news to share, right? The last 25% of our life usually isn't the healthiest. Right? It's usually when we're going to have more health conditions, not less. And we are far more likely to hit that point where we have that chronic manageable health condition that does need management, and that management is coming at a cost just so we can feel okay. Not even good, just okay, right? So are we planning that into our math for retirement? Are we showing that cost can grow on us over time? And is that, which I know Larry does, built into the plan, right? So that we know we're already facing inflation on every metric of things that we do. Is that built into our plan at the beginning so that we're not blindsided by it when it happens?
Mm-hmm. One of the many reasons to have a partner in all of this planning is making sure that you don't miss so many deadlines along the way, because that can be a costly mistake. And one of those mistakes is enrollment for Medicare.
Yeah, there's a lot of confusion on this one. So let's just say for the vast majority of us, I'm not going to deal with the disabilities or the illness-related Medicare, but just say they're turning 65, right? So Medicare is going to give us a 7-month enrollment period related to the birth month we turn 65 in. 3 months before that month, 3 months after it. We are on time applying for Medicare anytime during that 7-month period of time, right? But where the confusion happens is when I'm allowed to not do this stuff. When am I allowed to delay it without penalty? And I think Social Security does a great job explaining to that we will pay penalties if we don't enroll, but they don't do a good job explaining when we won't have to. And that is when we work for an employer with 20 or more full-time employees that has health insurance as good or better than Medicare, called credible coverage. If we have that credible coverage, we're now able to delay our Medicare past age 65, maintain those employer benefits that might be cheaper or better for us anyway, until we're ready to leave that employer plan. But here's a common mistake I see. Individuals thinking because my drugs are cheap, I shouldn't buy a Part D prescription drug plan, right? Two problems with that. First off, that is going to have penalties later. When you finally sign up for that drug plan, you're going to pay more than anyone else for that same policy because you decided to go without it for a while. And more importantly, Medicare doesn't let you sign up for all of these benefits anytime you want to. There are defined enrollment periods. So I warn that client, do you want to be facing a time that in June, your doctor says you need to take a new med, and that medication isn't just $10, it's $1,000 or
Right.
it's $10,000 or $15,000 for a 1-month supply of that drug? Do you want to make that tough choice of, do I buy this medication that's going to make me healthy, or do I have to wait till the end of the year when I can buy insurance to help cover it? Right? So no, don't delay on those components when it is that time, but do know you are allowed to delay if you're working for your healthcare and it's credible coverage.
Another major mistake I think people probably make is just assuming they can't afford any kind of long-term care insurance, and so just not addressing the issue at all.
Right. Again, that I'm going to leave it, stick my head in the sand and just pray it doesn't happen.
Yep.
Right. And again, there's a lot of disconnect there. People will say in surveys, if they're questioned, that if I live a long time, will I have to worry about long-term care costs? And we're going to say yes to that question. But then when it doesn't apply to me, the answer is no. Right. It's always going to be the other person that applies to. It's not going to be me. Right. And I go back to something Larry emphasizes all the time: the need to have a plan. Right? Regardless of what the plan is. If your plan is going to be, I'm going to pay out of pocket on my own dime, great. Let's see what that looks like when that happens. Let's see if you're okay with that outcome. And if you're not, then let's explore these other options so you understand, again, what are the tools I can use? Where can they fit into what I'm doing? And is there a place for this planning? But don't be afraid of the cost. Don't be afraid of the person that showed you the Cadillac to begin with and scared you away from the conversation. Don't be afraid of the conversation because you saw what happened to mom and dad on their insurance and you think that's going to happen to you on yours, right? Because there's a lot of new tools available that weren't there for your mother and father that are available to us in this planning today.
Right. Another major mistake, and we talked about this earlier in the show, it's not having your life insurance reviewed. You bought it when you were 45 years old, and now you're approaching 65, and that insurance policy could be eating itself up.
Exactly. I mean, again, the review is just going to simply tell you either you're okay and exactly where we want it to be and it looks great, or it's not. And it's a time you can still correct it before health has changed too severe, before age has changed to where it's much more prohibitive cost-wise to try to fix these problems that we weren't paying attention to. So let's do the review so we can catch these problems early and fix them before it's too late.
Absolutely. And this is one that Larry brings up so frequently, and it is so simple, but so easily done. And that's not updating your beneficiaries.
I'll comment on this because just this past week, I looked at 2 statements from individuals. Their beneficiaries were outdated. Okay. It sounds so elementary, but it's so very, very important. Beneficiaries in themselves is a form of estate planning. At least get that right. So making sure that your beneficiaries are current. And, we're talking this segment about mistakes. Last segment, we talked about annuities. Failing to understand the annuity terms and some of those key words, surrender charges and fees, payout options. A lot of times people get sold all these bells and whistles that they're never going to use, and it's costing them. So I always say, how much are you paying? Well, that's a good question, Larry. We have no idea. Well, you should know. The average variable annuity is 3 to 5% in annual fees. You don't know that because you wouldn't be able to get the answers and you won't find it on your statement. Just like in wealth management, I ask people, what's your management fee? We have no idea. And they're paying 2 to 3 times the going rate in the industry. Fees are not the end all be all, but they are part of the equation and they should be part of the discussion. And you know what? It's 2026. There's no reason why there shouldn't be full disclosure, expected disclosure. It should be wide out. It should be in the open. Nothing's free. And listeners should know.
Glenn, your takeaway from this entire show today.
Yeah. Take inventory, have it reviewed, and shop it out, right? If I could put it as simply as that, it's make sure you understand what you have. Both Leah and Larry have emphasized that. Make sure it fits into your situation, and make sure you've looked at your options for those things that you haven't planned for yet.
Absolutely. And how about you, Larry? What's your takeaway?
Well, ditto marks to what Glenn just said. All of a failure to plan is a plan to fail in any of these retirement areas, all these retirement puzzle pieces. Put all the pieces together, have a partner that can help you put the puzzle together. And I'd be remiss if I didn't at least say at the end of the show here, we have entered tax season. Okay. Lance, our CPA, and Melissa, our tax preparers. Get on their calendar. If you're not getting tax planning, you should be, but it's tax season, time to get it prepared. And by the way, if you didn't know, there's been a lot of changes in the tax code. Do you understand them? Do you have a partner? We're here to help. We love to help you at Haven Financial Group, and we appreciate you listening. Give us a call. We'd love to visit more. You know by now, we're coffee snobs and we like fresh cookies. If nothing else, you're going to get valuable information.
612-504-8400 is the number, folks. Give them a call today. Gentlemen, thank you so much. This has been great fun and lots of great information.
Thanks, Kim. See you next week.